Hi everyone, welcome to the Samira Q&A in terms of finance. When I actually booked this, I actually forgot it was bonfire night, so I didn't remember it's the 5th of November. So I apologise if in the background you hear my dog trying to attack some fireworks. So I do apologise to start off with. Thank you all for joining us on this. So basically, we're just going to keep it nice and simple and just cover the questions that you have in terms of finance. We'll cover sort of startups, we'll cover refinance, and then we'll also cover sort of purchasing the practice. So we'll try and get across all areas. If you can ask a question to us, that would be great, because obviously that will sort of help the flow in terms of what we got. We do have some questions that we've sort of put together as well. So we'll cover them off at the start. And then, yeah, if you just chip in with any questions that you have. Firstly, I'll introduce myself. So I'm Dan. I've worked at Samira for about 5 years now. I work on the finance team. And before that, in my previous life, I worked for RBS for about sort of 20 years. And the last 10 years of that working in the healthcare department. So a lot of healthcare stuff. And we've sort of seen it from both sides as a broker and seen it on the banking side. I'm joined tonight by a head of finance, Nigel. Nigel, if you want to introduce yourself, please.
Good evening, everybody. It's Nigel Crossman. I also worked for RBS.
Yeah,
I did 38 years though, so Dan's merely a boy. And I ended up for the last few years in healthcare, running the team that Dan was on, funny enough. But
so small world.
How we teamed up again afterwards. Yeah, we both left. So I joined Samira 8 years ago when we actually set up the finance brokerage. So we set it up from scratch. And now we've got 3 operatives. We've got Simon as well, who does property. That's all he does. He's a very experienced property guy. He's a developer in his own right. So he knows all about property development and that sort of thing. So it's very useful having him on board for the property side. But other than that, yeah, we've got lots of experience, lots of banking experience. And we find that dealing with banks, they like the fact we've got banking experience because we talk their language. We put things in the order they want, in the way they want, and actually we do most of the work for them, which is, they really do want that as well nowadays. So it's very easy for us to work with banks.
All right, thanks for that, Nigel. So yeah, if we just crack on, I say, first of all, I'll ask some of the questions that we've got, and then hopefully people will chip in with some follow-up questions as we go along. So Nigel, what I'll do, I'll ask you the question and then we can sort of take it from there. So first question we're going to start on in terms of startup practices. So how do lenders view startups?
Interesting, right? Lenders view startups in a little bit of a risky view, but there is no real reason for them to be a risky view if they're set up in the right way. And many banks acknowledge that. So whilst their policy is harsher towards startups, i.e. they won't lend quite as much, they do appreciate that the way they're set up is the most important thing. And the way they're led and the way they're proposed to the bank is the most important thing. So that most of them, they're quite happy to lend on startups. They come in and out of the market. Some people will lend for the property and not for the build. Some will lend for both. The good thing about banks lending is that you can lend over 15 years if you've got a lease for 15 years. And even if you buy the freehold, they'll still lend to you over 15 years. But that 15 years gives you such a low repayment on what is a relatively low loan. It will give you a much easier start. And they also often give you the first year interest only. So that it's all done to help. So whilst we say banks sometimes are a bit blinded and don't know what's going on in the market outside, that's a good thing that they give interest only. They've actually recognised that that's a good thing to do in the first year to help the person start up. They will normally lend up to 70% of the costs. That's the build and the equipment, and they will lend a maximum of 250,000. But over 15 years, unsecured, no property needs to be secured to it. That's quite a good deal.
Yeah, definitely. And I suppose one of the other sort of follow-up questions that people have in terms of that is sort of loan to values that people on startups? What the banks normally look at when they look at a loan to value for a startup practice?
Well, for a startup practice, they'll do 70% of the costs. If you're buying one, you see, for instance, they'll do 80 to 90%. So that's where you get the policy differential and where they consider it a little bit more risky. The good news is obviously that if you do a startup, your initial startup costs can be anywhere between 200 and 350,000.
Yeah.
Whereas if you're buying a practice, very often we're talking 6, 7, 800,000.
Yeah, yeah.
So that's the difference. So whilst you're borrowing a lot less, even though you're only getting 70%, the 30% you have to put in is less.
And in terms of the paperwork, because obviously, like you've sort of touched on, sort of buying a practice. What's the difference when you're doing a startup? What information will banks want to see that may be slightly different to when you're sort of purchasing an existing practice?
Right. So if you're purchasing a practice, let's cover that one first.
Yeah, yeah.
The stuff you'll need for both, you'll need to produce a CV detailing what you've done and perhaps a little bit of managerial experience where you've dealt with staff, mentoring, training, that sort of thing.
Yeah.
You'll
I
also
think that's quite key as well, like, because obviously dentists, when they're doing their CVs, are doing it normally to get a job as a dentist, where I suppose that's the difference when you're looking for finance, is you're trying to sort of get across the management skills that you've got, which people don't always think about when they're putting their CV together.
No, that's quite true. So you need your CV. You need your last 3 to 6 months bank statements to demonstrate to the bank that you run your account properly. And it also obviously shows what your income is. You'll need to produce what's called a personal liabilities form, which details your assets and your liabilities and your income and expenditure, so they can see what your lifestyle's like. And very often you have to produce 3 years tax returns or tax calculations or P60s, depending on how you're employed. So you have to produce both of those really for whether you're buying or whether you're doing a startup.
Yeah.
The difference on being a startup is obviously that they want extra things. So if you're doing a startup, for instance, they're going to want a business plan, quite a detailed business plan. They're going to want to know what you're going to do. What is the place now? What is the building now? What is it used for? What are you going to do to it? What's your mission statement? How are you going to run it? And that's the information they want. And they don't want War and Peace. They want 3 to 4 pages, just detailing how you think you're going to run this and how you're going to make it a success. And the good news for most people there is we can help with that. We can't write the plan, because it's very personal, and obviously you know the area probably better than we do. But we can tweak the plan to make sure it includes those things that the banks are looking for. But probably the most important document for the startup is the projections. So this is you telling the bank what you're going to do in years 1, 2, and 3.
Yeah.
Now the reason for that obviously is if you buy a practice, you can have the accounts for the practice for the last 3 years, which demonstrate what the business has done. For a startup, you're starting from absolute zero.
Yeah.
So your projections are very, very important. Now, it's important that these are presented in a way that the bank can understand. And we've seen many different variations of that, from almost the back of a cigarette packet. This is what it's going to cost me, and I divided it by 12.
Yeah.
To I mean, I had one the other day, very detailed, 35-page projections, which, to be quite honest, I mean, I've been in the bank 38 years, and I've been in credit, I've been in recoveries, I've been in every sort of place in the bank, and I struggled to follow it. I really did, because it was so detailed.
Yeah.
And some of the detail, the banks do not need. What we have, and Dan, I remember this from when we worked at RBS. We had an 8-page spreadsheet that you put all your costs into, and that produces your profit and loss and your cash flow. And the reason we do it that way is, one, the banks like it in a standard format. They like it clear. They can understand it. And then we put all the comments with it. So instead of just producing a load of figures, we produce the figures, and then we talk about the figures when we send off the application. Yeah. So we explain to them why we have made certain adjustments to costs or income. And so that's important for banks. So they're probably the big two that you really have to put together, and probably what people bulk at because it's new to people.
Yeah, yeah. And I suppose also in terms of the cash flow is making sure they're realistic as well, isn't it? That's one of the key things when you're doing it, because if it's unrealistic, then the bank are going to challenge the cash flow forecast, aren't they? Really, where what you're trying to do is make sure that it's realistic from the start, and the bank will believe your figures year 1, year 2, year 3. Because if you're going to, if year 1 you're making sort of 700, 800,000 turnover, someone may bulk, and we have seen startup practices do really well in the first year, maybe not as good as that, but it's making it realistic, because I think if they're not realistic, how can the bank rely on them that the figures are going to be correct sort of going forward, isn't it?
Yeah, realistic and sensible are really the two words. And very often, because what Dan and I do, when we produce the projections from the accountants and we've adjusted them to the special circumstances of each individual, we will then send them out to the client to have a look at. And very often the first comment is, I can earn twice that amount. Oh God, that's awful. I couldn't live on that. Well, the reason is we've sensitized the figures, because if it works on the poorest figures, it will definitely work on the best figures.
Yeah, very true.
And very often, I mean, I did one must be 5 months ago. It opened, and I was talking to the female dentist today about it, and she said, "Yeah, you only put 15 grand in the projections for month 6. We did 42,000 this month." And I went, "Well, yeah, it wasn't a target,
Yeah.
We weren't supposed to stop when you got to that figure. That was the figure you need to cover your costs and make a profit." So I said, from that, what you're saying, then you're making a damn good profit at the moment. And she went, "Well, yeah, it was all very exciting." And yes, because you've beaten the figure, and the banks expect you to make a loss in the first few months. And very often, when we get accountants produced figures, they don't make any losses in any month. And that's unrealistic, because the first month you're going to have very little income and you're going to have all your costs. So what you see is a gradual turn towards profit. And very, very often, I mean, Dan probably agree with this, 3 to 6 months to turn into profit.
Yeah.
It's an average on projections, and beaten very often.
Yeah. Nigel, we've had a question. So stress testing the forecast, what does that mean? So what do you mean when we stress test a forecast?
Stress testing is what banks often do. So they will take a forecast and they will basically attach a realism, be realistic about it. That's what you're talking about with stress testing. So they will look at it and they will say, I suppose an obvious one. So say in the first month you can do £40,000. Or your accountant says you can do £40,000. But your business plan says you're only going to work there 1 day a week. So the stress test will be the bank dividing the 40,000 by 1 day and working out that you're going to work 15 hours and saying, well, that's unrealistic. That's a sort of stress test. And so what the way we do the forecasts, the banks don't need to sensitize or stress test them any further, because they've got the explanations on the projections. They can look at it and say, the first month they said 3,000, the second month they said 7,000. So a good example would be in month 6, 7, we often put quite a large jump on the projections. And the reason for that is your patients from month 1 are starting to come back for a second checkup. So they're the sort of things that are stress tested. They're the sort of questions. Stress test is really questioning the figures and trying to understand them. So if you just produce 35 pages of figures and send that into the bank, they're going to look at it and not understand it and not understand why you've put certain figures. So it's about understanding what you're doing. So another good example there is if, for instance, you do implants. Now, if you do 5 implants a week, as opposed to doing 5 fillings, your income's totally different.
Yeah.
So therefore, when we're putting down the 5 implants a week, we've got to explain why it's so high, as opposed to the one we did with a bank last month when we put £2,000 a month. This month we put £7,000 a month.
Yeah.
So that's the stress testing. If you explain it to them, you reduce the amount of stress testing they need to do.
Yeah. So it's like about obviously putting the figures there, and I suppose putting your assumptions in there, how you got to those figures in terms of the notes. So that will help them sort of understanding that. I suppose another element of stress testing is when we look at the finance side of things, and obviously we wouldn't put it at the cheapest rate possible.
No.
We would, we put a sensitized rate within there. So if base rate does move, as we all know it has been a lot lately, thankfully it's starting to go down, but we will sort of factor in that base rate can jump up as well as down. So we'll factor that in, and that's another form of stress testing. So you'll put that in there so the loan would work on a sort of worst case scenario, isn't it, really, Nigel? That if base rate does move and go up, that the facility will still work and you can still repay the facility.
That's right. And another form of stress testing is, which the banks still do, is what we said earlier, you'd have to fill in a personal profile with your assets and your income expenditure. Now, if you've got a partner, let's say you're a dentist and your partner is also a dentist, which is not uncommon, or they're an engineer, they will have a salary. And the fact that they can cover the household expenses is another form of stress testing. Because the banks can then understand that you don't need to draw from the business until there's sufficient money being made in the business for you to draw. Because obviously in the first few months, you're not going to be able to draw any money out of the business. Because it's not going to be making profit perhaps in 1 month, 1 or 2. And you don't want to take money out as soon as it's making money. You want to leave a little bit of a buffer in there. So that's another form of stress testing. So stress testing covers all aspects of the finance.
Yeah, perfect. Cheers for that, Nigel. I think we've talked a lot about startup stuff. Now, maybe if we move on to refinance. So, but if anyone's, again, if you've got any questions, just put it on there and I'll ask the question. So, in terms of refinance, Nigel, why do people look to refinance their existing loans?
Well, there are many reasons. So, an easy one is the lender that you're with is no longer lending, and so you might want a bit more money, and therefore you can't get it because they're not lending. And a good example of that would be Wesleyan Bank and TSB, who are no longer lending in the market for dentists.
Yeah.
So if you've got a loans with either of them and you want another 50,000, you can't get it from them. So you would need to refinance. The other reasons are purely down to cost, really, and you're hitting the fact. Well, are you paying the right rate of interest? Have you got the right term on your loan? Did you get the right deal at the outset, sort of thing? And the level of your repayments is very, very important, because we do quite a lot of refinancing, and you can get your payments down by a considerable amount. And as long as you've got, I always say, a reasonable sized debt, it's no good having £100,000 or £200,000, because there are costs sometimes to refinance, and you might have to revalue your property. You might have to pay a fee. Now, the good news for customers generally is that we don't charge a fee for refinance. So that helps keep the cost down. But you might need to use a solicitor to take some retake the security. So there's a few little costs. So when we do a refinance, we not only send out what you could save on it, but we also build into it the costs that you will possibly incur to make sure that you can see at which point you're going to start saving money. I mean, there are some very good deals out there at the moment. I mean, I recently refinanced someone from, I think it was 2.7 down to 1.9. Now that's above base rate, I might add. Before I'm getting really excited there. And obviously, you might actually be able to refinance with your own bank. But I would still say use a broker, use one of us, because I had an experience the other day where somebody came back and the manager they approached told him he could put it down by 0.2, and we got it put down by 0.8 by going through us. So it's all about who you know in the banks and sort of what your contacts are, and are you dealing with the right people. So even if it's refinanced with your own bank, come and talk to us. It's not costing you anything to talk to us.
Yeah,
it's not costing you anything to refinance to us. So why not let us do the work for you?
Actually, we've had another question actually, and funny enough, we was discussing this earlier, Nigel. Actually, so we've got someone. They currently rent a room in a clinic, and now they're considering starting up a practice. And would that be classed as a startup?
Right, it's an interesting one. Yeah, if you merely rent the room, it's an interesting scenario. So it's more about whose book is it, whose clients are they. So if you're servicing the clients of the practice and you move, you'll obviously have an anti-competition clause in your contract, in your associate contract. You'll have to move a certain distance away, and you won't be allowed to approach those clients, obviously. So yes, that would be a startup.
Oh,
Now,
they are their clients. They are their clients.
Right. If you've got your own book and you move, it's an interesting one. The banks will still look at it as a startup on many occasions because it is a startup, and you have to. I suppose if you do the interpretation of the words, it is a startup. But they will often give a bit of an allowance because you're taking your own book. And of course, the advantage you've got there is you would still need to do projections, but your projections are less projections and more actuals.
Yeah.
You know, they're more showing exactly what you can do. So a good example of that would be, and one we were talking about earlier. I had a gentleman in Yorkshire who moved, and he took his book. Now, instead of renting the room, he paid 50% of what he earned. Now, the moment he moved, he doubled his turnover, obviously, because all of a sudden he's not giving away 50%. So his figures were stunning, to be quite honest. So if you've got your own book, yes, it is technically a startup, but some banks will look at it as a startup. Some will look at it, and this is the phrase me and Dan like, a transfer of business.
Yeah, that's exactly how I would look at it as a
That's
transfer.
what we hang our hat on, yeah, the transfer of business quote. Because
maybe one's in the bank, maybe slightly differently, but now I definitely look at it as a transfer of business.
Yeah, this is what we used to argue with our own credit teams. This is a transfer of business because what you're doing is you're moving a book over. So yeah, if you move your own book, it's a much stronger case.
Definitely. And as I say, you'll need them projections and stuff because obviously you'll have additional costs that you may not have at the moment there.
Well, you'll have receptionists,
exactly,
full-time nurses, you'll have insurance, all the costs, computer costs, all the costs that you might share. Well, you won't share because you're renting the room. If you're renting the room, that's sort of included in that rent.
Yeah.
So you will have those costs,
But I suppose the benefit that you've got in terms of that situation is most people, when they start up a practice, the fear is day one, I'm going to open that practice and there's no one going to walk through the door. Exactly. And, you know, that is a big fear for a lot of people and maybe stops them sort of going for it really. But in this situation, you've got that client base already and you may have outgrown the space that you're renting. So it's perfect. So you're moving it to a new site where you can grow and obviously, you know, add extra services really. So it puts you in a strong position for a startup or a transfer of business, as I would look at it.
Business, But and also because you're moving, okay, you might incur extra costs like having to have a receptionist and pay for your own electric and everything else. But of course you're saving the rent. So you know you're adding that back onto your income. So it's a swings and roundabouts sort of situation, and that's why you need the projections and you need someone to sit down and work out what it would look like. So what it looks like now, but what would it look like when you move is the very important one.
Definitely. Just on another question sort of about the finance stuff and timescales. So in terms of someone looking to secure the finance, how long would it take really? I know it's an open question, but they've got all the information they need. They've sent it through to you. What are the timescales in terms of what they can expect from us and in terms of getting back to them and sort of going through the process?
Right. Okay. So as I went through the list of things you might need at the beginning, but if you can supply everything to us in one go, and we've got it all there, we can write the application, and we do write quite a lengthy application. We don't send in your name your phone number and ask the bank to contact you. We send an application, we stress test it, and we put it all together for them so they can see that it works. Once we send that off to the banks, you within 3 or 4 days, you will get what's called offers of intent. So these are offers from banks of what they think they can do, and they will come back with the amount, the rate, the term, all this sort of thing. And you'll probably get, for a standard purchase, anything up to 5-6 offers of finance. Now, what we do is we grid those for you and put them all on a sheet, send them out to you so you can have a look at them. And we have a meeting with you to talk through them, because there are certain things in there you've got to be careful of. You know, people might have an early repayment charge, and that will cost you. Some people will lend you the money over 15 years, but will only commit to it for 5 years, which means at the end of that period, you've got to renegotiate it and go through all the costs again. So these are all things we will point out. We won't tell you which one to go for. That's your choice. But we will actually go through and say, well, that could be an issue. That might be an issue. You might want to be wary of that. Once you decide which bank you want to go with, that's when it becomes interesting, because obviously it's taken out of our hands and your hands and placed in the hands of a bank. And that then depends how good they are and how efficient everybody is. So we go back to the bank and say, well, Mr. A wants to go with, let's just use NatWest, for instance. NatWest will then allocate a manager. That manager will probably want to talk to the applicant, which they should do for all this money laundering and everything else. They're supposed to identify the customer. And then they will prepare an application for their credit team. Now, in all reality, me and Dan having the banking experience, that should take them less than a week. But again, we go back to, it depends on the person, depends on the bank. If it takes a week, it will go off to credit. Within 2 or 3 days, credit will approve it or decline it, hopefully approve it, because we've done a good job.
Yeah.
And then they will send out to you the terms, and you can start instructing solicitors and valuers. From that point, it will take you anything up to 4 to 6 months to buy the practice, purely because of CQC timescales, solicitors' timescales, and everything else. I think the important thing here is that while you're busy at work, we're busy chasing the bank.
Yeah.
So I suppose at this point they really hate us, because we're on them. Have you done the credit application? Has it gone up to credit? When do you expect the date? What dates are coming back? And we will just keep on their backs, because it is about who shouts the loudest gets heard. And if they're busy, we'll make sure ours comes to the top. The good news, obviously, for most of the banks tell us, is they can cut and paste our application into their credit application.
Yeah, definitely.
So we've done all the work for them, and that makes their life a lot easier for them. But even so, even when people are doing that, you will still won't believe how long some people take. We will, if you want us to comment on timescales when we're looking at banks, we can say who's quickest, who's normally quick, who's normally slow. But yeah, from start to finish, you're probably looking at 4 to 6 months. And the actual credit application of that, the business end of it, is probably 2 weeks.
Yeah. And I suppose you've spoken a little bit about the benefits of having a broker on board when we're presenting the case to clients. Is there any other points around that, or maybe other professionals that you should involve in the transactions?
I think it's very important to use professionals, and not to be too worried about cost. So we often get people say, I'm going to use my local solicitor, a friend of my dad's, or a friend of and you look at it and you go, we look them up and go, they're not actually healthcare solicitors. So use a healthcare solicitor. There are plenty around the country. We've got a list of people other clients have used, and they've commented very, very favourably on them. You want to get 2 or 3 quotes from everybody. So from solicitors, get 2 or 3 quotes, and so roughly what it's going to cost. You use, obviously, the banks will use a professional valuer. If you're doing a startup, use a proper building company. Use a dental build company.
Yeah.
Don't use somebody who's going to botch the job and then somebody else is going to have to come in and repair it all. That's the worst thing you can do. So just be careful. And I would always say use a broker, because one, you're using our experience and our knowledge. We're putting the application to several banks. We're totally independent. We're not tied to a bank. So you're getting a range of deals. Now, if you go into your own bank, one, you might get declined at source because you're speaking to the wrong person. We've had that several times, me and Dan. And then we've got the money from that very bank. So you get declined at source. You're going to only get their offer. So, if they're offering you, let's say 3% above base rate, they're not going to say to you, "Oh, the bank down the road, it's only paying 2%." That's not their job. They're not trying to con you, but they're only going to sell you their product. So it's best to get a range of offers so that you can have a good look around the market and make sure that what you get is right for you. Then you don't have to refinance in 5 or 6 years' time.
Yeah, you got a good deal.
Yeah.
We're just going to jump back one to the timescales one. Someone's asked a question. Does this timeline also apply to commercial mortgages for a startup property, or is it only for buying an established practice?
It is practically the same for buying a commercial property.
Yeah.
Yeah. I mean, normally if you're buying the commercial property at the same time you're doing a startup, it rolls it into one.
Yeah.
I mean, all you're doing is replacing the cost of the loan for the commercial property is replacing the rent that you would have paid. So, as long as you're not buying a four-story house in Chelsea, £4 or £5 million, you can do it at the same time. And we often do for startups. I mean, buying a property for 500,000 has been very common, especially outside London, because obviously you're not paying any rent going forward. The good news of buying a property is the bank will often lend you the money for the property over 20 or 25 years, which obviously really does reduce the payments. And again, you will get your first year interest only.
Yeah.
So yeah, I mean, always ask if the property could be bought, just because very often it can. The person selling it just has not thought of it.
Yeah, and the benefit you've got is that asset. So instead of paying that rental payment each month, you're making the loan payments, which are probably in line with what the rent payments are. And then at the end of the term, you've got an asset there where if you're just renting, obviously that money is just going to the existing owner, isn't it? Really?
Yeah, and you'd often buy the property in a separate limited company, and the reason for that is many, and accountancy team would need to get involved here, but obviously you can charge yourself rent, which goes into your profit and loss and reduces your tax. And the beauty of having a property in a separate company is that when you decide to sell your practice, you can sell your practice because that's in a different company, and then you can keep the property and you can charge another dentist rent for having it.
Yeah,
so it's a nice little income coming.
Yeah, perfect. Well, I think that comes to the end of the webinar. So thank you for everyone that's attended, and thank you very much for the questions. So I think for us, we just want to say, obviously, that we can help in terms of raising any finance that you need for, startups, refinance, or practice purchases. Like Nigel mentioned, we've also got an accountancy team. So if you need help in terms of setting up limited companies, our accountants are dental specialists. So if you want advice based on your sector, they will help you in terms of that. And we use Xero, so you can have up-to-date management information. So, we can help them there. And also the buying group that we've set up a couple of years ago. So that helps you save costs. So you've got a company on there that helps in terms of consumables. You've got a CQC company on there. And like Nigel mentioned, we've got practice design companies on there as well. So everything you need, sort of pretty much every stage of the being a dentist and looking to either purchase a practice, refinance, or start to practice up, we've got someone who can help, really. So please just reach out to us. We're more than happy to help in any way we can. Going forward, we're going to try and do a few more of these webinars on a regular basis, and we'll cover a few different subjects. So stay tuned, and we'll send out some more in the future. So thanks for your time and have a great evening.
Thanks, everybody. Good night.
Thanks. Goodbye. Bye.